Trading Bell asks, what is the mark to market official settlement price? So all data in markets are generally, so the thing that you'll always see is the last tick. Okay. So whatever the last tick is, then at the end of when the exchange closes for that hour, it will take everything, run its little algorithm, and then it will adjust the closing price to what is known as the settlement price. All right. And that's the official price of where it closed at, not the last tick, but the official price that was determined by the exchange. Do you have to add money if the value goes below the maintenance value? No, you would only add money when, so if you, let's say, never do this, but if you had a $6,000 account, right? And you're down lower than, so if you took a 20-point hit on the S&P and you're below what it's required to hold that contract, you will get what's called a margin call. Okay. They will literally call you and they will say you have X amount of time to put more money into your account or we will close the position. Okay. You can never let your equity, your total equity, fall below what you have in your account. Okay. Remember, they are holding this money for you. They meaning, like, think of it like a loan. Like, they're just holding that money to have that contract. You can still see that money. The thing is, though, is they're, like I told you guys, they're really strict. So if you're going to trade the S&P, ideally you want to have like $10,000 in your account for every one contract you trade, bare minimum. Why? Because you have double the amount of what you need to hold something. Okay? Like, you don't want to play the game of trying to be like, will they get margin call me? Like, you don't want to play that game. Okay? So you always want to make sure you have enough capital to trade to put up for the contract that you want. Okay? You want, a good rule of thumb is like double. So like oil is like $3,000 to hold. So what you want to do is you just want to make sure like you have a $6,000 account. Not that you're going to take a hit, hopefully, for like $5,000. You know, that would be an outlier example, but you just want to make sure you have enough funds to cover the maintenance margin overnight and for anything else that may happen. Okay, so you just want to have a margin. We call that a margin of error. Okay. So some weird things to understand about rollover. Okay, but before I go on, is there any other questions? Any questions about anything we've talked about up to this point? Cool. Let's move on. So remember, we talked about how we have to roll over these contracts, right? So hopefully this example back here made everything kind of like click together. Like, what is the leverage? What is, you know, how to calculate your risk reward by looking at these. You have to get, like, once you trade something though, like a commodity, like, you'll just know off the top of your head, like, how much you have to put up and, like, you know, what's the risk level of the contract going up and down, right? Because that's going to be what you risk, right? So if you want to risk $1,000 in the S&P, for example, you're going to risk 20 points basically on the S&P, right? Because 50 times 20 is 1,000, right? So wherever price is currently trading on the S&P, $1,000 stop loss is going to be whatever the price of the S&P is minus 20 points. Do you see how I did that calculation? Very simple. Okay. This is what you're really concerned with as a trader, as well as just what you have to put up. And the difference between leverage in futures and leverage in stocks, way different. Okay. And we talked about contract rollover And so I'm just gonna drive this into your head again, okay? All right. So with contract months, you can hedge either during the current contract month or in the future, which, unless most people like you will not do unless you are in a big industry. So if you are an oil tycoon in here, you need to understand hedging yourself in the futures market, okay? Like, that's an important skill to have. But for most of us, we're just trying to trade price from here to there and trying to make money, okay? That's what we're doing. We're not trying to hedge ourselves in terms of, I own an oil industry and I'm going to hedge my bets. We can hedge ourselves by trading different contracts, but that's an entirely different conversation. The point is, so if you're a day trader or for swing trading, you must be more sensitive to roll and always be trading the current month contract. And like I said before, indexes tend to roll every 3 months, and those 3 months tend to be HMUZ. So 3 times 4, I guess I misspoke before. So 3 times 4 is 12, right? So 12 months. So like indexes like the S&P, the Russell, the T-notes, like the bond market and stuff, they roll every 3 months. So those things are only going to have H, M, U, and Z. Okay, so remember that chart. You can go back or you can find it online. So those are the only contracts that exist. So it's going to be ESM, ESH, ESU, and ESZ. Those are all going to be the E-mini S&P 500 contracts. If we're talking about bonds, that's like a 30-year bond. That's going to be ZBH, ZBM, ZBU, and ZBZ. Okay? All right. So those are the only contracts that exist. Now with metals such as gold, they tend to roll over every 2 months, sometimes 2.5. And those only exist. So gold only has GCG, GCJ, GCM, GCQ, GCV, and GCZ. Okay. And the most difficult ones of all have to probably, because it's annoying because they roll over every freaking month, okay, is oil and natural gas. And the reason that's annoying is because it's generally in the middle of the month. So it's generally around the 15th of the month, okay? So if you're long January 14th and you're like, oh yeah, I'm going to make some dollars, mistake, because you're going to have to do rollover, which means you have to sell out of that contract and just buy in the new contract. So you might as well just buy in the new contract right off the bat, okay? And these tend to roll every month. If you are day trading, it's important to be in the most current contract month as you trade and be aware when rollover is about to happen. You do not want to hold a position into rollover because your broker will either deliver the physical commodity or charge you an exuberant fee just to click close position. It's like $50 or something. It's insane. But I'd rather pay that $50 instead of paying what it costs to deliver shit to my house. Okay. If you are long or short going into roll, close out your position. And if you still want to be long or short, just buy and sell in the next contract date. Okay. So if I'm long the S&P, just going to try to stick with the S&P here because I think it's the easiest to understand. So if I'm long ESH 17, right? And rollover is happening tomorrow. All right. So what I'm going to do is the night before or during the day of rollover, I'm just going to close out my ESH position, type in ESM 17, and just buy in that contract. Does that make sense to everyone? It's pretty simple. All right. So that's what I kind of just explained. So there's a whole explanation right here. For example, let's say I'm currently long the E-mini S&P 500 at 1800 on the ESM 16 current front month contract. I hold my position for about 3 months and roll is coming up. The next rollover contract month is going to be the U contract. Thus, on exchange regulated roll day, I will exit, spelled that wrong, my current position at 1900 or wherever ESM 16 is trading and close it out, then immediately buy ESU16 contract for the following month. Okay, pretty simple. Or if I'm day trading something, I just need to make sure I'm aware when contract roll happens and be out at the end of the day, or EOD. All right, end of day. There are two parts to roll generally. There's exchange regulated roll, and then there's liquidation. Usually liquidation follows a week after mandatory exchange roll. Okay, so you have the official rollover date, and then when the contract ceases to exist, meaning it will never exist again, this is called a liquidation. So everyone rolls over like a week before, and then the week thereafter, the exchange liquidates the contract, meaning it just stops trading altogether. Okay, you do not want to be caught. So you have a grace period essentially to get out of your contract. Let's say you're like me and you're doing 1,000 other things, and like you set your watch for contract roll, and then you're like, oh shit, I forgot to roll over my contract. You still have a couple days after the official roll day to get out of your position. You don't want to be caught in liquidation, because that is really when they force exit you, and you have to pay that exuberant fee, or you get delivery, and your broker will literally call you and bitch at you. Okay, they don't want to deliver to you anyways. Okay, it's very time consuming. Okay, so just know when the official exchange day for rollover is, set a calendar reminder or whatever it is, and then if you forget one day, that's okay. Just try to get out on the next day, and you'll be able to get out just fine. Okay, so after roll has happened, liquidation is next, and sometimes you generally can have increased volatility around liquidation, especially what's known as quad witch. So this kind of concept of liquidation also causes something. So remember, in liquidation, these contracts, so like ESM16, on a specific day, liquidation happened, and it never trades any further than that. Okay, it just stops in time. All right, I can go back and look at ESM16 and see when volatility and volume came in and when it traded and all of its prices. And then I'll see, like, on a specific day, there's just no more data for it. And that is when it happened. That's when liquidation happened and it stopped. Liquidation leads to something that's called quad witching. Okay, because remember, which we're going to talk about options probably in the next session, but options, futures, and a whole bunch of other options for futures, options for stocks, futures contracts themselves, they all expire. Okay, meaning they die and they never cease to exist again. And that, when there's a certain time during rollover, so remember when I said that, like, the indexes like the S&P, the NASDAQ, the Russell, they all only roll over 4 times or every 3 months, which is only 4 times a year. That's when quad witching generally happens, because you have this massive liquidation, meaning all of these contracts are expiring. And that leads to a week which we call in the futures world quad witching. And a lot of you won't get this reference, but Don Johnson used to do this ridiculous thing where he would take a sports coat and he would just roll up his sleeves ridiculously like that. So just remember, like Don Johnson, you got to roll them contracts. Okay? Period. All right? So overall, when this liquidation period starts to happen, it only happens 4 times a year on the 3rd Friday of March, June, September, and December. Like I said, pretty much follows the expiration of indexes. We see this thing that we call quad witch, and that's where index futures, stock index options, stock options, and single stock futures expire. Okay? And we call this quad witching because from the past, the expiration of futures options contracts occurred not only on the same day, but at the same time. And this often resulted in a period of greater than normal market volatility, which became known as the witching hour. Due to this increased volatility and frenzied market activity, many people trade very carefully or not at all during this time period. However, in my experience, this can be the most profitable time to trade if you know what you're doing. And I want to disclaim this. Some people to this day still take the entire week off from trading because they're scared of quad witching. Okay, a lot of volatility happens even to this day. So remember that. Okay, if you start hearing other futures talk about quad witch, you should know when quad witching's happening. It's on a calendar. Okay, this is not magic. All right, but quad witching happens on the third Friday of March, June, September, and December. Options expiration always happens every month on the third Friday. But during March, June, and September and December, remember, index futures, stock index options, stock options, and single stock futures, they expire. And they all expire at the same time on that Friday. And so there's a week of increased volatility, usually known as quadruple witching. Okay? So just be aware of that. So for most people that trade, they never look at futures as a viable option based on preconceived notions that have been perpetuated about futures and commodities. I don't trade Forex, but I do trade currencies in the futures market. Most people gravitate towards penny stocks, but futures and commodities can offer great risk reward. So, couple things here. All right. I want you to look at this chart between equities and futures. All right. So in the stock world, there's something known as the pattern day trading rule. What that means is that you can only have 3 round turns in a given day before they excommunicado your account, meaning they stop you from trading if you have less than $25,000. In the futures market, there is no pattern day trading rule. Okay? In the equities world, whether equities and penny stocks are part of the same world, a lot of people, especially in the penny stock world, like to go short. The problem is although the edge, which we'll learn, is in that specific world known as penny stocks, is known for shorting, it's really hard to find shares to short usually. And even in some of the bigger names, like equity markets generally don't like people shorting their market, so they make it really difficult. Okay, there are some brokers that don't even allow you to go short, which I think is illegal, because to have a transparent market, like, you need both sides of the coin. Okay, in the futures market, if you want to short the S&P, you'll have no problem doing that. You want to short oil? No problem. You want to go long oil? No problem. Why? Because it's a completely liquid market and there's none of these arbitrary rules. Okay. Also, if you short overnight on some brokers on equities, they charge you an exuberant amount just to hold those shares short. Okay. Don't ask me why. Again, it comes down to the fact that they try to deter people from shorting things. If you short something in the futures market, there's nothing outside the cost of what you already put up. Okay? And in equities worlds and the stock market, the market is really, the most liquid times are between 9:30 a.m. to 4 p.m. Eastern Standard Time. So if you are long or short overnight in a stock, okay, and the market or your stock gaps down in the morning, you can't do shit. You're stuck. Okay? In the futures world, though, because they're open 23 hours a day, most of them, so the equity indexes and all these things, if you put a stop loss in, if you want to get out of your position overnight because you just think it looks terrible, then you can do that. Okay? Because why? Again, it's open all the time. All right? Futures, which is the stage for all currencies, commodities, and indexes, is highly liquid, highly regulated, highly efficient market in terms of transaction and structure. A small investor or trader is literally, so all of us, okay, you're not big until you have over like $100 million, by the way, in the futures world. is literally swimming in a sea of money and thus does not have to worry about getting orders filled or other problems that may come with stocks in general. For every buyer, there is a seller, period, in the futures world. All right. Another great part about futures is they are data rich. Unlike stocks, which can disappear over time, like Enron, okay, one can backtest data in the futures market over long time horizons. This is a huge advantage because repeatable edges can be found in each market traded. Some edges are so robust through time that it's quite shocking how they have transcended over 50 years of data and millions of variables. Okay? Variables meaning like recession, war, all those things. All right, so if you guys, these are just some of the links that you can use if you want to see like where that, I pulled that contract information from. This is it right here. If you want specific rollover times and dates, you can go here. And if you want options expiration, you can go there. Okay. So that's that. And I think next week we'll pick it up on options. Are there any questions about this stuff? Or was it too much all at once? Yeah. So, and it's really important that you guys understand these basics, okay? Like, I know it's super, super basic, and I know it's kind of like daunting to start off with like so much, especially in the futures market, but you got to understand this because everything we do thereafter is just literally, data, okay? But you got to understand what you're trading. You got to know how this stuff is calculated. You need to know the benefits and the downside of like doing this stuff. Okay? I don't want to overload you guys. Of course. So once the class is over, like this will be uploaded to the site. Okay, Norman? It will take like a couple hours though. So I would check like after I do this stuff, like just check. Remember how I showed you guys at the beginning where stuff was? Check in that specific area, and that's where the video will be. Okay. Homework starts once we start to get through all of this stuff, Emily. But your homework really for tonight, or I would say even before next week, is really start thinking about really start to do some research. I'm going to go over like brokers and stuff, but start to do some research on who you guys want your brokers to be if you haven't done that already. Okay. And just really let this information sink in. There's no homework in terms of like, because this is just such basic information. Like I like to have you guys learn certain concepts and then repeat them back to me. So this kind of stuff I think is just really getting used to the information. It's not something that I believe a test would help you on. But one thing you really need to start doing is, start looking at brokers. And some of you are from different countries, so you gotta make sure. So it's not. I use TradeStation or TradeNav, and like I said, we'll go over that. But some of you don't live in the U.S., so those two may not be something that's an option for you. Okay, all I'm saying is just start thinking about that, start researching that. So Eric says, What would you say is a negative aspect or disadvantage to futures? I honestly don't see one. I don't think there's really a negative. It's just like anything else, it really just comes down to, trading and people being able to pull the trigger and understanding what they're doing. I mean, I pretty much think, in my personal opinion, like, um, futures are the most efficient thing there is, like, in the market. Um, and it's a thing that no one talks about, weirdly enough. So, but I want to present all the things that I know about, such as, like, what are stocks, which is what most people are familiar with, what are options, and, what are futures. And then you can decide, you can do all three, you cannot, but you need to have a solid foundation of all that stuff. And I tried to stress the main things that people get confused with between stocks and futures, and how they're similar. Like, they're similar in trading, right? Like, you're still buying and selling something, and some of the quirks that you have to know. Okay, so I can't really think of a disadvantage. It's just a tool. I think there's a lot of disadvantages to trading equities, though. Um, there's just so much BS regulation on equities. It's like, if people want to go short, like, there should be a way for people to do that. If people want to go long, like, there's obviously a way. Like, there shouldn't be uh all of this kind of, um protect this business from short sellers, or protect this from that. It's like, no, it's supposed to be a market. Um, if short sellers want to jump in on a stock and drive Apple to $2, like, that should be a thing that could happen. Like, just because you believe in a company doesn't really mean anything. All money, in a lot of ways, is what people determine a value is. You know, Apple could have the best products in the world, but if people don't think that anymore, then what do you think is going to happen to their stock? You know, so um, it's just. But the thing I like most, I guess, about futures is like, I get to trade things that I guess make sense to me. Uh, outside the indexes, which I trade a lot, like, commodities make a lot of sense because they're things that people, like, use. So that's the other, like, key difference that I like. So it's a more regulated market, but with less regulation, which is this really interesting concept. David says, I will definitely watch this 2 to 3 times for my homework this week. That's good. Um, Marcus asks, is it better to have a corporate entity or just use our own name to set up account? Marcus, I can't answer that question legally. Like, it's literally, you have to figure out, you need to talk to someone. Germany is very different in terms of taxes than the US. Only because I know that, because when I worked in Germany, I got smacked in the face a lot. It was like, oh, you made $4,000. Yeah, we're going to take two of that. That sounds correct. Oh, sorry. I mixed you guys up. Sorry. Are we going to go over what drives commodity prices? Yeah, we're gonna go into some of the fundamental stuff, Eric. Um, I mean, because ultimately, for commodities, like, supply demand obviously plays a huge role, but it doesn't always work out symmetrical. So just because there's a lot of oil in the world doesn't mean oil can't, go up $10. You know, but eventually the song and dance ends, so to speak. Yeah, Marcus J, not Marcus Fisher. Marcus J, please talk to someone about the difference between doing one or the other. Okay? So, whoever you have as a tax person. And if you don't have a tax person, just schedule an appointment with one. All right, are there any other questions? Take that as a no. All right, guys and girls. Well,